We're joined by Ben Emons, founder and chief investment officer at FedWatch Advisors. Ben, great to have you with us.
Hey, Mel, it's good to be on again. Thank you.
So we saw that record hit on the S&P 500 early in the session, and then the market started really thinking, like, uh-oh, why do we really need so many cuts? Are you worried that there is a growth scare ahead of us?
Not really, actually, Mel, because I've noted from the GDP data and even from some of the ISM and regional PMI data, there's a little bit of a turn higher there. If you really look at forward-looking indicators, the retail spending data was solid too. And then yesterday, the productivity data that came out was actually really strong, and that's a good signal. So it seems that the economy has moved out of the summer swoon, so to speak, but we're dealing with this labor market weakness, which is traditionally a lagging indicator. And that labor market weakness, I think, troubled the market a bit today. But the underlying economy shows some level of strength. So I think we're setting ourselves up for a stronger fall period. And as the Fed follows through on these rate cuts, it will stimulate once again the economy.
As long as inflation remains tame. And maybe that is the biggest wild card. We're getting CPI next week. And if it proves to be hot, that is really a quandary that the Fed will be in, and the markets as well, for that matter.
Yeah, I would agree with you there because, there's one thing, of course, that the market will pay attention to is that we had an uptick in the unemployment rate today. So if you're getting that hotter CPI, you get a bit of the stagflation narrative coming quickly back in the market's mind. And that is obviously the negative part of it. Now, the recent PCE data was comforting. There was not like a significant pass-through from tariffs, not an acceleration on the underlying trends of inflation. So that's the good news. But it's obviously a bit of a wild card going in there. It will not derail the rate cut, I think, for September. But if it's a hotter data, then this 50 base point cut may not actually happen, which is still my view, but it's I think not likely then. So it is a touchy point next week for the market.
Ben, Tim, but it does mean that the dollar, which is a little further away from this, the direct hard data, even though it obviously is impacted, and that's the point. I mean, we had a weaker dollar today. Is weaker dollar trade back on? And if so, I think gold's got 30 to 40% in the next 2 years. I really do. I think the gold trade's not late in its life, and I think it's a trade that's picking up momentum. Your thoughts on either the dollar or gold?
Well, the dollar definitely could get some more weakness because it would have the discount now that the Fed's not going to do just one rate cut. It's likely going to be several cuts from here. And that also seems to be within the FOMC more the narrative building at this moment. So that would in itself bring, I think, the dollar broadly down against most major currencies. The gold trade is interesting because that always is that reflection of Fed easing as an expectation, and perhaps some level of inflation still plays a role in people's mind, but it's also about the uncertainty itself. We still keep to deal with this tariff uncertainty. We got the actually uncertainty about the Fed itself too, of how it will play out in terms of composition. So gold, I think, continues to be bid up also for those reasons. So you could play this long gold, short dollar trade here. I think it's a good entry point here, given that it's likely this Fed has no choice but to start making more moves into year end than what previously was priced in.